but Anand Rathi Wealth now reported a strong set of first quarter numbers. They achieved 96% of its AUM guidance for FY25 in the first quarter itself. Now, assets under management also grew 16% quarter on quarter. To discuss more on this and the road ahead, Feroze Aziz, the Deputy CEO of Anand Rathi Wealth, is now joining in to discuss the numbers in detail. Feroze, good morning. Thanks a lot for joining in. Well, let's start off with the AUM number itself, right? You're guided for your AUM figure. You've already achieved 96% of that in the first quarter itself. You look to revisit that number now for the full year, and how much of that has come from this resultant market recovery that we have seen in the last month and a half?
Good morning. Like you rightly pointed out, we've met with God's grace a lot of 96% of the guidance for the year with respect to AUM. Point one, a large portion of that, which is 3,366 odd crores, comes from net flows, which is up about 173% vis-a-vis the same quarter last year. We had collected about 1,200 odd crores in the same June quarter in FY24. We've collected almost 3 times that, or 3,300 crores, which is 173% to be more precise. So that's one variable. Second, because we collect long-term monies only, we have a very strong gatekeeping. We don't bring liquid monies of corporates or large treasuries. We focus on intergenerational wealth. So the equity proportions are larger. Unlike most other wealth management outfits, you see 54% of our total assets, which we report, are in equity mutual fund with our ARN, which is going to be very clearly standing out in the industry. So point I'm trying to make is, when the economy does well, and if your proportions are going to be long-term monies invested in equity, the mark-to-markets are also greater. The mutual fund selection, which we do large, deep selections. So that gave an alpha over the Nifty as well. So I think 3,300 crores, the large component in terms of 173% increase in the net flow, which is what I think we have to thank each of our client and prospects to give us larger wallet share, is one of the reasons.
All right. Hi, Feroze. Good morning and good to see you in. Looking younger, I think looks like these results are rubbing off onto the look as well. Looking younger every time we speak. So kudos on the numbers. You know, going by the AUM numbers that you put out, don't you think it makes sense to revise both the revenue and the PAT estimates that you put out at the start of the year? Because it's been a very, very strong start. What would the revised numbers look like?
Nigel, thank you for that great comment. If I have to be worthy of sharing a screen with you, I better look young, at least as half as young as you are. That's what makes me worthy of sharing a screen with a handsome hunk like you. So that's my point one, and I'd say most of the female viewership would have a lot of motivation to see you and your screens. Coming to the more serious subject of our results, we personally think that under-commit, over-deliver is something which our professional guru, who is Rakesh Rawal, the CEO of the company, who's been the CEO for the last 17 odd years, has always told us, be it a client commitment, be it an internal commitment, be a shareholder commitment, whomever you are speaking to, pran jaye but vachan na jaye. That's the kind of thought process. With that kind of thought process in the DNA, at least we attempt to not revise it upwards at this stage, because mark-to-market ups and downs happen. Net flows is on our control, and that's where we are focusing to try and bring 800,000 crores every single month. And we have a very simple business model. We don't bring assets which don't earn us 1%. We want to earn our clients 13 to 15% compounded return, and we want to earn ourselves 1.1%. We filter all the assets at the entry stage. So if we bring 1,000 crores every month or 800 crores every month of fresh flows, anybody will be able to very easily extrapolate what will be my PAT in the next 5 years, giving a mark-to-market of 10-12%, which is a God's gift to our business. So to answer your pointed question, no revision, it's at least not 9 months before the year end. But we'll always strive to do better than what we speak to credible channels like you, to make sure that you're not over-committing and under-delivering ever.
Okay, let's focus on a couple of aspects then. Structured products, you know, it's at around, I think, 24-25% of the mix. The guidance, I think, was to get it to around 30 to 35%. By when does that happen?
Nigel, see, most of our clients, we recommend 25 to 35%. So yes, we were at 29%. Equity mutual funds grew substantively because our model portfolio gave 16% alpha over Nifty last year, and has, as we speak in this quarter, which has gone by, it has generated an alpha of 6.3% on Nifty. So the mark to market on equity mutual fund is higher. That's why you see 48% of equity mutual fund has moved to 54% in spite of the assets growing from 59 to 69,000 crores. So point one, coming to your pointed question, realignment is something which we are going to focus on. It's always very important to realign from the asset which has performed in the rearview mirror to an asset which brings in stability. So I can't tell you a date, but definitely realignment is the mantra. So that proportion of 24% into structured products will move towards 30 by the year end, give or take. Please don't hold me to that, Kapil.
Indeed, but Feroze, you had earlier mentioned that your relationship manager guidance, you look to add around 40 to 50 per year, and you have already recruited around 28, if I'm reading it correctly, this quarter itself. Now, what's the road ahead on that? And employee expense for you as a percentage of revenue has also inched higher. Now, as business grows, would you look to increase the number of recruitments as well? And what's your sense on the employee expense as well as a percentage of revenue?
So 2 points. I think in terms of number of relationship managers, we have a very important thought process which we have tried to hold on to for the last couple of decades, is to not get carried away and expand so much that your DNA, your culture, your social fabric, your delivery in the marketplace gets diluted. So we are now never constrained by capital or the capability to spend. We are generally constrained by, are we able to find enough people who match our thought process? So coming to the point, we will always try and make sure that we train our people internally. So 80% of our latest recruitments are internally trained account managers promoted to relationship managers. Coming to your pointed question, the guidance in terms of the number of people increase will also not be revisited. If we find good people in good locations or internally, then we hire, because just spending money to recruit people is something which is not our forte. And what you would definitely see, I think it's one of the first few times in the Indian financial services history that we have seen 1 year of zero attrition in Anand Rathi Wealth Limited. Regret relationship managers, this quarter is also zero attrition. So bring in no leaking bucket from a client perspective, from an employee standpoint. So you do great gatekeeping is when you can deliver 0% for one full financial year, which I think in financial services industry should be first few times this would have ever happened.
Indeed. Feroze, always a pleasure speaking to you. Thanks a lot for joining in. Wish you good luck for the quarters ahead and for the full FY25 as well. Feroze Aziz there from Anand Rathi Wealth on the road ahead for the company. 0.7% higher, but the stock has moved up significantly. 550 was the IPO price, Nigel. 4170 now is the stock. So it's been a great performer for investors as well. Time for a short